Welcome to the Political Risk Podcast, where geopolitical risk and insurance meet. I'm your host, David Benyon, and my guest is Jérôme Haegeli, Group Chief Economist at Swiss Re. We're here to discuss the latest Sigma study prepared by the Swiss Re Institute, World Insurance in 2025, a riskier, more fragmented world order. The report focuses on the impact of US tariffs, expected to slow global economic and insurance premium growth. I'll attach the link to download the Sigma study to the episode description. As Group Chief Economist for Swiss Re and Head of Swiss Re Institute, Jérôme is responsible for Swiss Re's global economic and insurance market research programme, as well as external engagement of Swiss Re on advocacy and partnerships with Group Public Affairs, partnerships and the Strategic Council. He's also the managing editor of Swiss Re's flagship Sigma research series. Jérôme's research team provides macroeconomic and insurance market forecasting, research and scenario analysis for Swiss Re and its clients. His role also means he engages with global policymakers as a leading industry voice for the insurance and reinsurance business. Jérôme is a member of external advisory committees at the Institute of International Finance and the World Economic Forum, including its Geopolitical Advisory Board. He's also a board member of the International Capital Market Association, the London School of Economics Financial Markets Group, and serves as director of the board at the China Asia Pacific Reinsurance Research Centre. He previously served as co-chair of the World Bank's Global Infrastructure Facility Advisory Council. Previously at Swiss Re, Jérôme was head of investment strategy for nearly 10 years. Before joining Swiss Re, he was the Swiss National Bank's delegate to the executive board of the International Monetary Fund in Washington, D.C. This is one of those big conversations that manages to relate high-level macroeconomic and geopolitical risk themes to some specific outcomes for the insurance world, for premium growth, claims, and the risk environment, for lines of business such as cargo, marine, and motor, all the way up to property catastrophe reinsurance business. So lots of food for thought. Enjoy the episode. Jérôme, thanks for joining me on the podcast.
It's great to be with you, Dave. Thank you for having me.
Just by way of an introduction, would you like to begin by introducing the Sigma report and giving us a flavour of its key takeaways? So in terms of economic growth forecasts and themes for the global risk environment.
No, very happy to do so. So this is our World Insurance Sigma report, which we traditionally publish around this year. So it's taking kind of a half-year outlook over the next 2 years. And in terms of the key takeaways, we look at the economic environment. On the economic environment, we expect the global GDP growth to slow down, actually quite abruptly this year because of all the uncertainties that we are seeing, the tariff increases, but it's not just the tariff increases in the US. We expect global growth to slow down from 2.8% last year to around 2.4%. We see the US economy also slowing towards 1.5% this year and then recovering somewhat to 1.8%. But for the US, this is extremely a low growth environment. It's also fragile. And for the euro area, we continue to expect growth to be subdued and just slightly below 1%. So the growth environment, it's slowing, it's fragile, there's a lot of uncertainty out there, and we translate in the Sigma report also obviously what it means for the insurance industry. And for the insurance industry is being hit by the slowing global insurance premium growth. We expect premium growth to slow down to about 2%, especially life is likely to be impacted. Remember, the life insurance industry had a really extraordinary growth environment last year and the year before, thanks also to higher interest rates, and that's subsiding somewhat. It's remaining at a higher level, but life insurance premium growth, we expect to slow down from 6% last year to around 1%. And we expect the trade-exposed sectors, be it marine or construction, to be harder hit than the other sectors. So this is a little bit the kind of the environment where, if I have to describe it with an analogy, I think it's definitely going to be a continued roller coaster. It's up and downs, and you feel like you're upside down. And we also look at regime shifts in our Sigma report of what the regime shifts on the political front, on the fragmentation front, all means both for the macro as well as for the insurance front.
Focusing on claims in particular, but looking at the consequences of the tariffs we've seen announced in the Trump administration and where the biggest effects or consequences might be, which lines of business or territories do you expect will be most directly affected by the imposition of all these import taxes on claims? And is it all negative? Could we see claims go down as well as up in some areas?
It could be that claims growth goes down in certain areas, but I still doubt it. There's still a lot of demand. There's also a different and change in terms of the risk sentiment because it's a more risky world out there. You also are more, as a risk manager or corporate or household, you're also more conscious about the risks. So your demand of insurance is structurally higher, meaning the growth slowdown probably this time around is less sensitive and has less of a direct impact to insurance market lines. But in terms of the insurance sector implications, we believe that for the direct insurance lines, the hardest hit will be US motor, property, construction, marine, and trade credit, just because they are so cyclically sensitive. And obviously also for marine is something which is extremely high sensitive to the global economic cycle, and trade credit is very sensitive to the shock that you are seeing on the tariff front. We would expect also that the claim severity increases for the US motor and US construction remains at higher levels, not double-digit levels for US construction that we had seen during the COVID areas, but still around 3 to 4%, which is somewhat higher than the inflationary environment that we see for consumer prices. And actually, I think it's really interesting that if you look at the insurance sector implications of the world we are in today, the regime shifts that I just mentioned, the regime shifts happening because of shift to protectionism, fragmentation, or the policy volatility. Outside the US, it's actually not as inflationary as for the US, and we see more disinflationary or deflationary effects. So to your questions, you see negative claims growth. I don't see it, but if I were to expect it somewhere, it's probably outside of the US because you don't have that stagflationary shock outside of the US, given also you didn't have so far the retaliation in terms of the tariffs.
And essentially the same question to you, but focused on premium growth rather than claims. And again, are there some areas where you'd expect to see perhaps some positivity in some demand for insurance products precisely because of the risk environment, rather than it's all bad news in terms of less growth?
Absolutely. I think there are actually lots of opportunities. And if you look at surveys, there's a lot of pessimism out there in terms of business sentiment, also consumer sentiment. Fact is, look at markets. Look at equity markets. If you look at the German DAX, it's up almost 20%. If you look at the US, it's up around 7%. Maybe the sky is not as blue as equity markets tell us, but still there is also lots of opportunities, structural opportunities for insurance industry. And I think one of the structural opportunities, and I emphasize structural because I think I would have a higher confidence as an economist look at structural factors than just cyclical factors because of things moving so quickly. And I think the reconfigurations of supply chains, however the trade war plays out, the reconfiguration of supply chains, that doesn't happen overnight. That's a multi-year, decade-long development. And Dave, if you look at the ratio of financial markets, let's say the S&P 500 and real asset, you see real assets over financial assets. That's not just the case for the US, that's also the case for other markets. Never in history did you had the ratio of real assets to financial assets, meaning prices for real assets relative to financial assets being as low as today. And I think the reindustrialization trend, reconfiguration of supply chains, it means a structural revival of the real economy. And that means you have increased demand for industrial and infrastructure insurance, but not just industrial and infrastructure insurance. You also will have climate and liability considerations that come with it. I think here about the liability exposures in areas like environmental risk or infrastructure overall, or then also opportunities in new risk areas, which will come with the reconfiguration of supply chains. And I think here about emerging sectors like semiconductors, renewable energy, as well as defense. So lots of opportunities out there in our world of the business, in the insurance business. So don't take the point that global growth slowing down, premiums coming down somewhat as well. Premium levels remain at high levels, and also we're going to see quite some shifts going forward in terms of where growth will come for the insurance markets. This reindustrialization of the real economy, I think it's a big theme, and it will stay for us for quite some long time.
Cargo seems like it's central to all of this business, where you really can see the immediate consequences of tariffs, and you can see the effect it would have on pricing, but also on potential claims, all that's going on. Could you just speak a little bit about cargo for a second as well?
Happy to do so. So on cargo prices, and it's also really interesting, we saw the volume of cargoes from east to west, from China and US more particularly. We saw it slowing down in Q2, especially towards the end of Q2, as first the cargo volumes remained at a higher level, because once the April 2nd Liberation Day tariffs increases were announced, that they would become effect in a few weeks, you had an anticipation of, because of the higher tariffs, inventory build-up, so you have higher exports. But once that was passed and inventories were built up, you saw that cargo volumes actually came down. Now, in terms of cargo, marine, or trade, there we do expect these lines of businesses to be harder affected from the global political risks and fragmentation that comes with it, and also the supply chains reconfigurations. Which doesn't mean, the last point with supply chains reconfigurations actually also means there will be continued life in the trade and cargo insurance lines. Reconfiguration of supply chains doesn't mean that suddenly you don't have trade anymore, but trade will be differently. Actually, it will be more costly. So more longer term, it could well be that you see cargo, marine, trade as business lines actually seeing a structural revival. Shorter term, cyclically, I see these lines of businesses coming down, but structurally, I think we could be in also for a revival, just because of moving the business from just-in-time production, global businesses, right? Global supply chains, moving them from just-in-time to just-in-case also means you might have these ships around in a more longer route, more complex routes, and that will also have its effect on insurance.
Looking to some of the other geopolitical events taking place in the world, so clearly whatever peace currently exists in the Middle East, tenuous ceasefire between Israel and Iran, there's clearly a lot of risk of, again, cargo really, but trade disruption in the Gulf, in Strait of Hormuz. And we've already seen big trade disruption in the Red Sea for the past year. That's actually just begun to have been more attacks there as well. There's some additional geopolitical events that are not to do with the Trump administration, not to do with tariffs, but are part of this picture. So if you could give a comment on how some of that might pour fuel on the fire in some respects. And I think it's an interesting point about you saying that trade supply chain changes tend to take a lot of time to manifest themselves. But some of these events are happening really quickly from one week to the next. So yes, seeing as the example of peace is so fragile at the moment, what outcomes would you expect based on a re-escalation or conversely a cooling off of tensions?
Well, first of all, in terms of what we are seeing or what we have been seeing in the Middle East, and what it means. In terms of what it means, for sure, Middle East escalation, it raised the risk of a renewed oil price shock. And that's why you made the analogy with the 1970s. And it also enters, in my view, a new chapter in geopolitical tensions. However, the Middle East tensions, as long as the Strait of Hormuz, this is really the worst outcome, because the Strait of Hormuz is responsible for moving about 20% of the global oil supplies. As long as the Strait of Hormuz remains open, and there was no doubt, actually, if you look at market pricing, that it could be closed, and there was also no commentary or speculation that it could be closed. But as long as the Strait of Hormuz is not closed, the effect on the global economy through the global oil prices is contained and will remain contained. And this is why actually oil prices year to date are down again. And price of Brent per barrel is now below $70 again. So it's a risky situation in the Middle East for sure. It has escalated, but it also has calmed down since then. And geopolitical tensions are still here, no doubt. Maybe the geopolitical risk premium is too low in the oil prices, could be. But if you look to history over the last decades, you don't have long-lasting impact either of the oil price changes on inflation. And even if you have a sustained $10 increase in oil prices, it increases the consumer price level by around 0.5 percentage points. And even that is not that long lasting. So that's also something to keep in mind. Middle East, it matters. It matters for sentiment a lot. It matters for oil prices. But it's very rare to see events that have a long lasting impact, which doesn't mean it couldn't happen, but it's important that we look at what would be the factors leading to a structural change so that the Middle East tensions would have a long-lasting impact. And that's where the Strait of Hormuz comes in. If the Strait of Hormuz is closed, I would see oil prices moving up to $150 per barrel, and that would mean US CPI, at least for a quarter or two, close to 5%, reducing US GDP by 0.5 percentage points. It's a hit. It would be bad. It would mean a recession in the US, probably also a global recession, but we are nowhere near there. And I think that risk has also been decreased since the escalation that we had seen on June 13.
With all the heightened political risk and uncertainty and this fragmentation of economies that the report talks about, let's move on to what that means, whether it's a significant threat to the insurance industry and its growth and prosperity. And in some ways, if we could relate that to reinsurance in particular, that would be great to understand how it's not just primary level, how reinsurance could be affected.
Very happy to do so, Dave. So in terms of what fragmentation means for insurance, but in particular also for reinsurance. So fragmentation of markets, what is it? Fragmentation of market means that you cannot pool capital around so easily anymore, either because of taxes or because of capital flow restrictions or because of increase of collateral demand. Overall, fragmentation, it impedes cross-border reinsurance and the opportunity that you have and the possibility that you have to diversify global risk and pool the global risk more locally. And that means insurance becomes more expensive as fragmentation increases. And that means the costs of insurance for households or corporates increases. So foremost, higher fragmentations is a cost borne by society because it's less efficient. It raises capital costs and it widens at the end of the day also the protection gaps. Maybe I give you one example in terms of what it means that you have actually the diversification benefits and what the diversification benefits mean for the reinsurance industry and especially then also for the risks that we had seen materializing. And let's take the Hurricane Katrina, for example. Hurricane Katrina event 2005. The Hurricane Katrina event, or the overall event that played out in 2005, you actually saw that 12% of US insurers, they received reinsurance payments equal to 100. 100% of the equity was paid out by the reinsurance industry. And that's what we saw for 12% of the US direct insurance players. And a quarter of the direct insurance players in the US, which were affected by Katrina, they received payments actually exceeding 1/3 of their equity. And these figures, I think they illustrate really, really nicely the benefit of having global reinsurance, and global reinsurance you can only have if you have a diversification benefits. And for diversification benefits, it's really important that fragmentation risks remains at bay.
Obviously, when people talk about the purpose of reinsurance being capital protection versus, some of the other reasons that companies might give for purchasing it, that puts things in perspective in terms of what would happen if that reinsurance level of protection was not there. I think it's just interesting because it's not immediately obvious sometimes when thinking about geopolitics and political risk meant in the broader definition beyond the insurance world. What that means, obviously that's a lovely, neat example because that cuts right across to natural catastrophe risk and property cat. in a way that I think is often not thought of coherently, perhaps by a lot of commentators. So I appreciate the example.
Totally agree with you, Dave, that what it means if you meddle with the trade order for goods is one thing. It's well understood for exports and imports. But what it means if one were to meddle, and also we are not there yet, and I think the risk that we would be going there is low. But if you change the tariff for services, with that you have market fragmentations, then it's a total different ballgame. I think we can digest higher tariffs on goods, but higher tariffs on services or restrictions on services and the flow of capital, I think that's a total different level, and that would be much more costly for growth, for jobs, for households to bear than what we are seeing today.
So I'd like to ask you a different sort of question next, more of a personal one for you as an economist. So amidst all this political risk, geopolitical risk, the fragmentation of economies, an era of insecurity, I've heard it called, that we've just seen in the last, since Ukraine 2022 onwards, perhaps before. Does that mean that you are being asked different questions by your own leadership and potentially by clients as well? Yeah, just curious what difference it's made for you in that respect. And there are other things I could ask you, aspects of the same question, really. Because of those different questions you might be being asked, are you reaching for different indices or new data that may not have concerned you previously? Or is it just that the outcomes look so different now than they did a few years ago?
Well, great questions. And I would say yes to everything that you asked. Yes, there are new questions. Yes, there are new indices that we look at. And yes, there are different outcomes. And it's an area, high volatility. Yes, we all know high volatility macro, high volatility on financial market front. But at the end of the day, it's not just volatility, which is nothing new. It's a regime shift. The regime shift. Personally, I think we are just at the start of the regime shift. Again, as I mentioned, supply chains that don't just change overnight. It takes decades. That's why the reindustrialization theme, I think, is a really important one. Second, it's a political economy. There's a lot of industrial policy happening all around the world, not just in the US. It started with China, it slipped over to US, and Europe will also be following, and for good reasons, right? There's nothing wrong with that. So I think as an economist, you have to think about many, many different factors nowadays than before. You have to look at new indices, policy risk indices, uncertainty indices. You also have to look into more micro factors, and you have to look very carefully also at what new policies could mean, right? And out of the US administration, we are seeing a lot of new policy becoming alive.
There's a line in the report, I'll paraphrase it, that everybody loses from trade wars ultimately, that obviously the cost of doing business goes up, and whatever political statements might be made about potential gains to be made, they're kind of offset overall. Everyone loses. Something along those lines. I just think it's interesting because obviously there are so many things that, rationally speaking, it would make sense to happen. But it feels like in this new era, you're getting more irrational decisions. Or, I mean, the obvious one is Russia-Ukraine a few years ago. No economist would have foreseen that because it was clearly an incredibly stupid thing to do, rationally speaking. But this is the problem when you have a very politically active era. People don't behave as rational actors, and that there are other considerations that you might not have borne in mind, but actually do drive behavioral stuff.
Very true, which is why scenario thinking is really important, right? Keep scenarios close home, look at what would be triggers for moving from one scenario to another, and be prepared also to change your view when the facts change, and don't take rationality as a given. Think about the political economy and look at the key structural factors. That I think is really important.
Yeah, so the report mentions that there's likely no going back to the open world trading economy prior to the US Liberation Day tariffs of the 2nd of April. Well, obviously those tariffs were somewhat delayed, so a 90-day pause, but that doesn't change the fundamental point in terms of there's no going back, I assume. But the outlook seems so uncertain, particularly given the unpredictability of the Trump administration. So do you think the insurance industry is well placed to show resiliency against all that uncertainty? The resiliency for itself, for its own sake, but also to maintain relevancy for its clients and policyholders amidst all this profound shift in the risk landscape? How resilient is it?
Absolutely. I think the insurance industry is very resilient. And I think not only very resilient, but I think it's even more important, the insurance industry and the insurance sector in today's world than it was before, for a number of reasons, but foremost also because we live in a higher risk world. Why do I say what I say? Because if you look at capital costs, right, and this is something that we look at our Sigma research very often, and it's really important to look at capital costs and compare it to the return on investment as well as the return on equity. And findings are, even though interest rates are likely to remain higher for longer, and they are higher if you look at 10-year rates in the US, they're above 4%, even though growth is slowing down, that will stay like that. And the capital costs, in our view, is likely to continue to be covered, right, by the industry, which is important, and which wasn't always the case before COVID. So the industry is in a good place in terms of its resiliency. To be resilient, the company or an industry needs to be resilient itself. And if a company or sector cannot cover its capital costs, it's a problem. Maybe not for year one, but if it doesn't do it for a while, it will become a structural problem. So from a profitability perspective, the insurance industry is very sound. Second, if you look at SST ratios, SST Swiss solvency test for Swiss companies, but if you look also at solvency ratios for European players, the industry is also very well equipped with equity and capital to absorb peak risks. And especially the reinsurance industry has no problem in terms of capital cost and also is very strong in terms of the capital to absorb shocks. Can it deal with changes in the regime shift, the industry, the global industry? Well, yes, absolutely. As long as you have fragmentation not increasing, the costs of playing its part with diversification benefit is not structurally affected. But if you have fragmentation increase, then the costs of global diversification being offered by global players will be affected. So I think your answer is absolutely yes, resilient. And it's a different environment now than also during COVID, because COVID, inflation surge, I don't see this as very likely. You have a supply chain driven inflation increase or inflation staying higher for longer. And it's also more asymmetrical, meaning it's more in the US than in Europe. Our forecast, for example, Dave, for European inflation, it didn't change that much from November till now. And there was no need to. The trade war affects actually the US much more than Europe. But yes, I think to your answer, how relevant and how resilient in the industry in this environment, it is and will remain resilient, and the industry will remain extremely relevant and more so now than before.
Well, I certainly hope that's the case. Jérôme, it's been a lot of fun, really interesting talking to you again on this. I don't want to say one topic, enormous topic, really, huge, and a very interesting report. I'll certainly include a link to it along with the episode. So hopefully I'll see you again in Monte Carlo in a couple of months' time, but thank you very much.
Have a very nice summer and looking forward to seeing you soon, Dave. Thank you.
That's all for another episode, and I hope you enjoyed this conversation, which I think is an important one, relating the consequences of the Trump administration's policies, tariffs and trade wars to their consequences and outcomes for the commercial insurance and reinsurance markets. Thank you for listening, and please join me next time for more top guests and discussion of the interplay between specialty insurance business and the tense geopolitical risk environment. I've been your host, David Benyon, and I'd like to thank my wonderful guest, Jérôme Haegeli at Swiss Re. Production was by Peter McGill, and my cousin Lawrence Durkin made the music.